So wherein the client also takes some partial benefit of this rupee depreciation, which is passed on to the client. So I think net, yes, impact will be there, but I believe again this is a very transitory. Rupee depreciation is something which we have seen time and again. Every 3-4 years we see a sudden downtick in the rupee, and then again it goes back to a normal level. So I think yes, benefit will be there for a quarter or two, but post that, ultimately in the long term everything averages down. So clear-cut beneficiary IT and pharma, and at the same time companies which are high on foreign currency debt, obviously they will have a little bit of an extra payout, which will be seen in upcoming next 1 or 2 quarters. So those companies will definitely lose out in a short term.
All right, Sunny, do stay with us, and Kunal as well. We have to slip into a very quick break on the program. We'll be back on the other side to take you through Market Open. Do stay tuned.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook...
Welcome to India Market Open, and let's be a few minutes away from how the pre-open will look like. Will it look decidedly different or no is the key question. And you know, while our experts have given their initial takes, I think it'll be interesting to hear from Kunal, especially at 9:08. What is it that he would want to do? Simply because the index will be showing a slightly different tune than what we've been used to in the last few days. The only question is whether the mid caps and the small caps will show a different tune as well or no, remains to be seen. Let's watch out for all of that for sure. You know, before we get to newsmakers, Kunal, I want to understand from you if there are supports that are getting that are close by for some of the power utility companies. Yesterday, from a Tata Power to a JSW to an Inox Wind to CESC, everything related to power had cracked and cracked viciously. Are any of these near supports, or are the supports much lower?
Good morning, sir. So yes, the supports are very lower. In fact, Tata Power is the counter which we were also holding because of sideways consolidation. But you know, as the technicals always support us to be on the correct side, we actually exited near 395 once it broke below 400 levels. You see the crack; it's now 339, 340 kind of levels. But still, there is no hope of survival even at this level. The only support which I can see on Tata Power, because that's what is the counter which I'm tracking very closely, is near 320. As of now, it looks like a falling knife. So, you know, better to stay away from these counters by any chance, even if they want to reverse from this level. A bit of consolidation is expected first, right? So, staying away from this counter is better. But as of now, there are no immediate supports on the chart.
First minute or so of pre-open rates, and of course, no great takeaways right now. But just look at an Indian bank for a second, GIC, Go Digit General, some of the insurance names buzzing this morning in the first minute or so of trade, and seeing some action over there. So Kalyan Jewellers showing a bit of recovery after being hammered the last couple of days. I want to see what's happening to a Dixon, because there's news that Tata Tech is now speaking to Xiaomi. Any impact on a Dixon there? Mildly in the red, nothing major. But what's standing out for me is also Angel One. Look at it, Angel One on the back of its numbers. Let's look at some more of those capital market plays as well, and Anand Rathi, among other things. So a bit of pain point will continue. Let's look at a BSE while we're at it. Capital markets is one thing to watch out this morning. BSE on the back of good note, which we'll get you in just a couple of minutes from now, from Jefferies, is moving pretty sharply. Sunny, I just want to come to you on the question of the impact of F&O volumes dropping off. And does that fundamentally change the outlook on capital market facing stocks?
Again, coming to capital market, I think the impact will be different for a different set of companies. I think brokers are the one which are predominantly business model is driven on per lot basis brokerage charge. So definitely they are going to hurt maximum because of the drop in volume on F&O front. But again, they have got many levers to recoup the lost revenue. So definitely increase in charges is something which is on anvil across the industry. So most of the brokers which are predominantly dependent on F&O side, case in point, Angel One, or for that matter, Share India Securities, Zerodha, which is an unlisted market leader in this space. So they are the one who are likely to take a price hike to recoup the lost revenue. Again, coming to exchanges, I think exchanges, they are more dependent on option premium, right? So option premium number is something which has not seen a significant dip post the change in regulation. So I think exchanges are someone are the least that are likely to impacted with the change in the regulation. So I think again, BSE is the only play which is available at a current juncture. And coming to the wealth managers like Nuvama or 361, again, their exposure to the overall F&O as an segment is very less. They are more of an AUM-driven trail income driven business models. So I think again the impact for them was anyway very negligible. So they continue to ride the wealth management growth story over the period of next 3 to 5 years. So clear-cut beneficiary looking at data of the last 2-3 weeks is basically exchanges, and brokers need to definitely strategize on increasing the revenue either through increasing charges or launch of new products.
Sunny, interesting points that you're raising there. Incidentally, Bernstein has come out with a review or a rejig of its portfolio, and it's an interesting list of stocks that are being deleted from the list, and a few interesting names making the cut as well, likely on the back of price action over the last couple of months that has resulted in a change in the way valuations are looking right now. We've got Agam joining in to tell you about that change. Agam?
Right, so, well, Bernstein has come out with this India strategy note in which, as you've already mentioned, they have made some deletions and they've made some additions to their model portfolio. When it comes to deletions, well, what they have in mind is to reduce a lot more risk with respect to the significant correction that we've seen in a whole lot of these stocks. This should include something like the Reliance Industries, HDFC Bank, REC and Zomato. And in terms of additions, where we are seeing those in IndusInd Bank, Coforge, Bharti Airtel, Adani Ports and Jubilant FoodWorks. Among a handful of reasons given for these changes, as far as the additions are concerned, where they are positive on Adani Ports, and they say that this recent correction makes for a good point for as far as the entry is concerned. They're also pretty positive on Bharti Airtel in terms of how things are panning out with respect to the entire telecommunications sector. On the other hand, they are not so sanguine when it comes to REC and Zomato specifically, and given the current correction that we have seen, then they do find it at this juncture that they would want to reduce their exposure to some of these companies, considering the fact that they have the kind of up move that we've seen, and then also the sharp reduction. And finally, coming down to Jubilant FoodWorks as well. Well, looking positively as far as the consumption sector is concerned and the theme there is concerned. And these are some of the reasons behind their rejig in their model portfolio.
Thanks, Agam. Another interesting note coming through from Jefferies. We just spoke about capital market players, and this one is about BSE. It has upgraded BSE from underperform to hold, and the target price has also been hiked. Harsh is joining in to tell you some of the perspective there. They are talking about the drop in volumes on the derivative side. Harsh?
Well, they do, Alex. They talk about the drop in volumes, but they also talk about how there'll be a divergence where exchanges versus other capital market players is concerned. And what they're saying is that the new F&O measures have impacted option volumes, and premiums are in fact down by around 10% thereabouts, even in January month to date. Traders, though, are moving to larger average ticket sizes. This is, of course, contracts which are longer as well. And exchanges, therefore, will gain with stabler top lines and a large margin expansion on the back of improved quality of premiums, is the thesis that Jefferies is putting out. Discount broking volumes, though, can see a bit of a hit, in fact, over 40% of a hit, and will need large increases in terms of pricing. So that's what Jefferies is putting out. They are neutral with regard to asset managers, but the huge upgrade is with regard to BSE. From 3,500, target price hike to 5,250. They've upgraded from an underperform to a hold. While no upside here, but just the quantum with regard to the hike in target price really stands out in the note today.
Okay, 2.5% higher, and as 908 settles down, Harsh, thanks for that. As 908 settles down, BSE remains a stock that we should talk about, but I also just want to get in the other capital market plays alongside. So both Anand Rathi Wealth and Angel Broking should come up on your screen as well. Angel One down 3%, Anand Rathi Wealth flattish in trade. But you know the difference out here, viewers, is that if you see Angel One's journey from 2100 went up all the way to 3100, is back to 2370 or thereabouts, right? Very volatile. You look at Anand, look at that choppiness. Look at Anand Rathi Wealth, and I think there is almost a linear move higher. Stability, linearity, 42% gains just shows the difference currently. Sunny, Jeffries seems to believe that exchanges, wealth managers are the players you want to bet on. Don't bet on brokerages for the time being. What would your bet be on?
Yeah, definitely. I think brokerage companies are basically dependent on F&O as a revenue. If you see, like Angel, 80% of the business comes from F&O as a segment, and there we have seen a lot of changes on regulatory front, and that is impacting their top line. I think, but having said that, I wanted to keep in mind that ultimately, if you look at number of active clients on NSE, and that ratio in terms of population is hardly 2-3%, 4-5 crore of active client base. So I think opportunity on a longer time frame is huge for all these brokerage companies. And at the same time, Angel One has smartly diversified their business. So if you see, they are incubating many new businesses, whether it is on wealth management front, and at the same time trying to bring in one of the best-in-class fintech platform distributing loan. So I think maybe a pain for a quarter or two where we will see an increase in cost for Angel One because of this incubation of the new businesses. At the same time, hit on the F&O side because of the change in regulation. But at the same time, they have got many levers also, right? So the brokerage rate has been at a multi-year. In fact, I remember in 2008, the average brokerage rate was close to 1%. And now we are staring at 0.1% or a flat 20 rupees kind of order. So I think there is a humongous scope in terms of increasing brokerage charges for. So many levers are available. Yes, in the short term, broking as a business will definitely come under pressure. But looking at a multiple lever, I think it's a good opportunity to accumulate market leaders like Angel over the period of next maybe 6 months in the portfolio.
Top pick here. So top pick here is Angel or just Angel?
And Nuvama. Yeah.
Okay, Angel and Nuvama is what you'd buy if you wanted a capital markets play. Would you buy a BSE today?
No, BSE is something I think it's fairly valued at the current juncture. So better I would like to buy on dips as far as BSE is concerned.
Okay, no dips in sight, at least in the first bit of trade. Kunal, I want to ask you about the Bank Nifty. Is it going to see some recovery today? What the first few minutes of trade are showing, or at least the pre-open session is showing, that banks might make a comeback. BFSI actually in focus. Insurance names also buzzing. General insurance data has been out, and we'll get you details on that, of course. But would there be a Bank Nifty play today?
So as I discussed with Alex, 48,000 seems to be the good round-off level also and the support level also. And a bit relief rally till 49,000 is likely, but just have to see whether it holds these levels. The resistance level is 49,000, so we'll have to watch out for that level as the ballpark figure for the reversal.
All right. I'm curious about, Sunny, what you make of the real estate pack. We saw one developer come through with earnings yesterday, that's Marathon. I didn't see the pre-sales number, but there was a decline both on the PAT as well as on the top line. And you've seen a significant decline in the shares over the course of the last couple of trading sessions, particularly yesterday, over 6% on the real estate index. Do you think this is simply a correction when the pack was a little too hot, or do you think there's something underlying there?
I think yesterday's correction was more to do with an likelihood of a delay in a rate cut by US Fed and a pursuant delay in a rate cut by emerging markets or emerging economies like India. I think that has led to something wherein rate sensitive like real estate were under pressure along with all the other mid cap and small cap. But having said that, I think there are a few players which are likely to report a very good set of pre-sales number. A case in point, Sunteck Realty. I think they have reported a decent set of pre-sales growth number for the December quarter. So few players like Sunteck, or for that matter, we have seen a very good correction on Century Textile, which is Century Realty now. Aditya Birla Realty, the name of the company has changed. So I think it's a good opportunity to accumulate a few quality names which are focusing on Bombay and Bangalore as a market. Noida, Gurgaon seems to be slightly overrated in terms of prices also, and slightly in terms of launch pipeline. So I think real estate companies focusing on Bombay and Bangalore as a market looks relatively well placed at the current juncture.
Very quick call, Kunal, on a BEL, if any. Would you look at a BEL, some movement after a while, and of course on the back of an order win news which has come in?
So there was a massive gap of opening on 21st of May, and that level which was a breakout level, was 260. Counter is holding on to 260 levels. So this can be a good bargain buying opportunity provided it holds 260. So with the stop of 255, one can definitely initiate a buy on this.
Kunal, we have 20 seconds. Your top call for the morning based on the pre-open rates. 20 seconds.
Looks HCC as a very good bet right now. Gap up open. So with the stop of 31, one can initiate a buy on HCC.
Hindustan Construction Company. That's what Kunal is betting on. So keep an eye out for that one. A bit of a up start. Let's see if it builds on from there. You know, the Nifty Bank is up 200 odd points. It was a BTST call given by Hemant Kapadia in trade yesterday when the market was essentially sulking. So works well for people who actually watched the show and acted on it. But nothing dramatic, about 1/3%. But it's okay. We don't need too much of drama. This is welcome, about 0.5% now, with the Bank Nifty really leading the charge. I wonder if IT is participating, maybe not, maybe it is, or maybe it is a bit of a drag because the banks are certainly participating. Nifty IT very quickly should come up on your screen and then get the mid caps and the small caps, or let's just get the heat map up on the screen, what have you. Yeah, Nifty IT is sulking, and that explains why the Bank Nifty is much better behaved than the Nifty 50 because IT is dragging this lower. Wonder if HCLTech has a part to play there. We'll find out in just moments from now. Mid caps and small cap indices very quickly, please, before we get to the heat map. Or let's just go to the heat map straight away. 1% higher for the mid cap index, which is actually a good sign, and the small caps too should be positive. Let's get the heat map up on the screen and show you what's moving and what's not. But broader markets are doing well. HCLTech is down 5%. While they raised the bottom end of the guidance, I thought the commentary was positive. I wonder what warrants such a strong negative reaction. I couldn't find a reason why, to be very honest. But well, the street in its wisdom believes that this is bad, and therefore it's dragging down the others along with it. All 5 IT majors in the red currently, and that's the only sore spot. What's doing well? BEL on that order win, small order win, but the overall order size for the year over 10,000 crores. There is strength in SBI, Adani Enterprises, NTPC. Adani Ports, IndusInd Bank, Hindalco, Tata Steel, effectively a bounce back which is across the board, save for IT. And you know, we'll get a call on HCLTech after we're done with the stock spotting, but this is really, really sulking. And I dare say, I don't think the numbers were so bad. I would be really surprised if it closes the day 6 or 7% lower, Tamanna.
Already 6% lower. I mean, yes, there was a miss on revenue, there was a miss on PAT. It was tad below estimates, but then the guidance was quite positive. They've upped their revenue guidance as well. Deal wins are at an all-time high, dropped quarter on quarter though. Whatever it may be, the street in its wisdom is dumping HCL this morning, and not as, I mean, the other major tech stocks are following, but not as painful as an HCLTech. So that's the picture there. Let's pull up the sectoral heat map very quickly. We already know mid cap and small cap indices are doing okay this morning. IT definitely down, dragged by some of those big names, and HCLTech primarily, I would suppose, responsible for that. FMCG, all right, flat, but more green on the screen. This is a bit of a bounce back of a market. Will investors go out and sell those rises is the question. PSU banks roaring today. PSU banks making a comeback. Metal stocks doing really well. So are energy stocks, despite crude prices shooting up. Not too much of a pain point over there. The BFSI pack is where the day belongs. Look at the recovery in the Nifty reality as well. Worst beaten down sector yesterday. The index nearly 7% down. Not that it's anywhere close to those recovery levels, but at least about 1% up. The commentary now moving to stock-specific plays, and let's look at how the result candidates have performed this morning. Angel One, Anand Rathi, Delta Corp, Himadri, some of those that reported yesterday in trade, all of them down in the red. And you know, this is the pain point that will continue no matter what else happens at the end of the day. If results are not up to the mark, if corporates earnings are not up to the mark, that pain will continue. Angel One about 4% down now. Anand Rathi also slipping in trade. Delta Corp not showing any kind of relief. And I don't know if you can pull up Himadri very quickly, because those numbers were out as well, and those numbers were relatively not bad. That's reflecting in the stock price. 1.5% up. I want to quickly check crude impact. Is this a factor that markets are ignoring this morning? ONGC, Oil India, likely, expected to go up if crude prices are spiking. Both of them in the green. HPCL, BPCL on the other side also going up even as crude prices internationally spike. So all of that in the green. Indigo, Berger, Kansai, Nerolac, some of those crude-facing companies, well, the street's not bothered today. Berger Paints up about 1.5%. In fact, the consumption play is coming back into focus. Is there a sense that there will be some spending this budget? Perhaps that's what's driving the market. I want to pull up BSE very quickly. 2 days in a row, there have been positive notes. Yesterday, it was Goldman Sachs. Today, it's Jefferies. Stock is roaring 4% up on BSE. The F&O volume drop has not hit exchanges as much, seems to be the consensus there. So even though you're seeing an Angel One hotting, BSE is doing okay this morning. So these are some. I don't know if you can pull up some insurance plays, because that's the other leg which has seen some impact. General insurance data seems to be fairly positive, and you're seeing some moving over there. I suspect the likes of a Go Digit, etc., are also doing okay this morning, Alex.
Yeah, absolutely. And quite a few of those movers, a couple of moves that are contrary to what you might have thought. One, of course, is HCLTech that was pointed out. And let's see where it is at right now, because it was down 6% and has it recovered? No, it's actually lost further ground, down about 7.8%. And the other that is moving contrary to what you had initially perhaps thought is Anand Rathi, which is losing ground, down over 3%. Despite a 30% improvement, now 4.5% lower, an improvement in the headline numbers, pretty decent numbers, one would argue, 39% growth in assets under management and a bonus issue as well. But the stock reacting negatively. We will soon have Vikas Khemani with us to talk about his outlook on the markets. But before we do, let's take a look at some more of the movers on the benchmark. At least you have right on top some of the bigger movers. You have Adani Enterprises that is now up as much as 3% and building on those early gains. NTPC, Hindalco, Adani Ports also gaining about 2.8% or so. Tata Motors, early on in the day we were talking about this counter, not too far away from a 52-week low, but recovering in trade today and up as much as 2.4% or so. BL also building on those gains, up about 2% right now, Neeraj.
Okay. Well, clutch of names out there. Quick opening thoughts from our experts really on the key names that are moving. Kunal, anything that stands out for you on open for a trade?
So Neeraj bhai, as we discussed, HCC is looking very attractive. It's showing good strength also. So considering the today's low as a good stop, one can initiate a buy after 9:30, just waiting for the new high after 15 minutes. That's the first counter. And the second, a very small bank is IOB. Now this counter is also up by around 3.5%. Yesterday's bottom seems a good stop with stop of 45. One can initiate a buy, and the quick targets on this can be 50 plus levels. So yeah, these are the two counters to watch out as of now, and then we'll see how the market shape up further.
Okay, fair call. Gentlemen, both of you, thank you so much for taking the time out and being with us and giving us your time. But it's just an opportune time because the markets have been in such pain in the recent few days to get in somebody who's who looks at the slightly longer term, is largely constructive, to get his views on how does he see, is the glass half full or glass half empty. Vikas Khemani, founder of Carnelian Asset Management and Advisors. Vikas, good having you. Thanks so much for joining in. And it was important to have you on the phone as well, just because of the pain that exists in the markets currently, right? I mean, people's portfolios have taken a serious beating the last few days. How are you seeing the texture of the market currently, Vikas?
Hi, Neeraj. Good to be chatting with you. So I think clearly, we had a great, last couple of years. And when you're coming out with that kind of backdrop, it's very natural to have these kind of, intermittent corrections. So they don't really, bother me as much. Of course, nobody likes market going and correcting, but that's the nature of the market. Right now, currently, the setup is because of the current global macros, the way they are playing out. There's a change of leadership happening. There are quite a few implications of those leadership, the policy changes from US. Now, how they will pan out, I think market is so when you are sitting at this kind of a reasonably priced, kind of scenario in the market, it's very natural to have this kind of correction. I'm sure the global macros, there will be some clarity, in next sort of 3-4 weeks or maybe a couple of months. So I would assume that I'm not seeing anything alarming, but for the fact that there could be a good scenario of rupee depreciating. I mean, Chinese currency might depreciate given whatever tariff proposals get carried out by the US. The intensity of that depreciation will determine Chinese currency depreciation will determine the US Indian rupee situation. So I think that's the one probably little bit of uncertain environment right now we are in, that how rupee will settle down and thereby impact of that on the inflation. But I'm reasonably sure that this is not going to be disruptive from a long-term India bull story. We might see another, depending on again what's the intensity of that, we might see some bit more correction, or we might kind of consolidate here. Frankly speaking, no answer for that. But I mean, I'm not seeing any kind of worrying sign. Any such period of corrections are more as an opportunity than really a big risk.
Guys, point taken. In yesterday's move, though, you saw broader markets crack quite substantially, and while we've seen foreign institutions selling over the last couple of months since August in the benchmarks, or rather in the large caps, in the broader markets, do you think yesterday's move was largely a sentiment breakdown because of the rupee? And do you think that settles, or do you think that earnings coming through might cause people to waver a little bit?
So, Neil, I think it's a combination of 3-4 things. One, I think U.S. yield hardened, in the recent past. The earlier story was that if U.S. yield softens, emerging market will see flows, and which happened, I think, around the first Fed rate cut. But then I think that narrative right now looks like that change, and thereby, and also second one is a little bit of hardening on the crude oil price, which is contributing. So I think this is building the fear in Indian markets about interest rates not likely come down anytime in hurry, including in India. And secondly, probably if the crude price hardens, can this have an implication on the inflation? So right now, I think we are in that a little bit of uncertain, macro environment. And whenever there is uncertainty in the macro environment, it tends to have an impact. And whatever selling we saw, I think it's been coming down, and sometimes it could be a combination of some of the leveraging, unwinding, some of the I think we have seen some actions from SEBI of certain specific players. Some of the unwinding of those positions could be there. So combination of multiple things. The environment is slightly more precarious, and in this kind of environment, it is natural to have these kind of reactions. It does happen. We've seen this movie before. So I'm not like I said, there could be some more pain behind, but I think any amount of correction in the euphoria-built stocks is good. In my opinion, that's where the real value of quality, real value of sustainable earning, real value of less story-driven, more fundamental-driven story comes about. The approach comes about, and in that sense, I'm quite happy that these kind of corrections do from time to time tend to distinguish good players versus bad players.
Vikas, good morning. I like that line. We've seen this story before. We've seen this movie before. I wonder what the end of it is going to be, or the finale. Because right now, I think what people can't figure out is whether today you're seeing, a bit of a relief rally, but all of these negative factors, are they persistent in the system? I mean, look at the first few set of corporate results that have come. Would it be fair to say that that's the biggest worrying factor?
So I think, again, probably finale of this movie will be more nifty of 1 lakh, 2 lakh kind of thing in the long term. That will be the finale. In that finale, there will be intermittent episodes of, these kind of pain points and, violence, and as it happens in the movies. So, don't worry about these episodic situations of that. And they will happen, I'm again telling you. Otherwise, there won't be any interest in the movie. You won't enjoy the finale. You won't enjoy the journey. So there would be these kind of situations. And that is where I think also distinguish between hero and villain. So I would say that this correction is I mean, nobody likes, if given a situation that everything should go one way up only. But that's not how it happens, right? So I would say that there could be a little bit more pain behind, depending on how macro develops. And I think next 1 month, 1.5 months probably could be, which is what we wrote in our beginning of the year note, that this beginning, the first 2-3 months could be a little bit of painful in terms of either time correction or value correction, and hence it's probably invest in the market with low expectations, invest in the market with a little bit of high risk, take your risk bar high, and that is what I think is playing out. I'm not worried about it from any destabilizing factor, either on the corporate earning or India story or tax collections or macro story, whatever you can look out. I'm really not worried about any of those. That's what I would probably say.
Okay. By the way, HCLTech is down 8%, so just keep that in mind, viewers, while we're talking about the longer term. Just keep that stock in mind because that stock is really getting a pounding today. Bit surprised at the extent of the correction, but it started off 6 and it's now 8.5. So clearly the market is not liked a couple of things out there. And we'll talk about that in moments after we thank Vikas Khemani. But Vikas, one final question really. With an assumption that your 2025, a lot of your funds will be getting in more capital, would you be tempted to deploy that for the sake of definition, I'm just defining it, in the non-nifty mid-size, small-size companies, because the profit pools of some of these companies seem to be very, very strong even now? Or would you believe that the market would punish valuations at that end independent of the profit growth, and therefore maybe it might be prudent to look at larger caps currently despite maybe slower profit growth?
So, Neeraj, I think, we have different strategies and different strategies have different mandates. So we have manufacturing strategy, which is doing well. And so each strategy has, there's a multi-cap strategy. So we kind of stick to the mandate of those strategies. I don't think we might do a little bit intermittent tweaks, but having markets corrected so much and also some of the individual names correcting 30, 40, 50%, they definitely, I think, more merit if you take long-term perspective to stay invested into that. Again, the point is that what kind of risk do you want to see? Are you seeing the risk of short-term volatility in your portfolio? Then you should be worried about mid-cap and large-cap. But if you are worried about that, there are two other risks, whether it's risk of permanent loss of capital or risk of opportunity loss. If you're worried about those two risks, then I think small and mid-caps are better, where the quality of the management is ensured, quality of the business model is ensured, because those are the ones who will, of course, returns. There's no question on that. So again, it depends on the perspective of the investors. We will continue to stick to our philosophy. We don't think anything is disturbing happening on that. In last couple of months, whatever money we've got, we've deployed only 30-40% because we were kind of expecting a bit of a soft market. So we've been now in this period, we'll be gradually deploying whatever money we have been left. So all our new clients have been sitting on 30, 40, 50% cash, which we will use this time to deploy. We as an investor love these kind of corrections because it gives us 3 to 5 years a great opportunity which you will never otherwise get or you rarely get.
Thank you so much for that, Vikas. 86.50 on the rupee. I mean, that's one concern perhaps which is weighing down on an HCLTech also this morning. Because while the Nifty back up about 0.5%, not bad to see some green on the screen. The Bank Nifty is what is actually roaring. And HCLTech looking like in a world of pain. I mean, 9% down on the stock. We'll get you a detailed look at exactly what is ailing HCLTech. But yeah, you want to come in?
No, Tamanna, just one thing. I wonder, just before we get to our next guest, I just want to one is HCLTech, yes, of course, important. But I believe the exchange has a release of Adani Energy Solutions bagging orders worth 28,500 crore rupees. And I wonder if the street has taken note of that. Should just maybe pull that stock up and see if that one is doing okay. Just want to mark that. Adani Energy Solutions up 5% today. It started off flat. I think the street has missed this in the release that the company is given, but this is large and therefore could be interesting. Just wanted to mark that.
Yeah, stock is about 5.5% up. In fact, entire group stocks are also up in the green today. So pull up End, Ports, and that entire list is looking like it's making a big comeback. All right, we were talking about the rupee. HCLTech in pain this morning. Rupee could be one reason for it, but there are two sides of the coin when it comes to rupee, and no pun intended there. The other side is that is it good perhaps for exporters? To get that perspective, we're joined this morning by Sivaram Krishnan Ganpati. He's Vice Chairman and Managing Director of Gokuldas Exports. Just the right person to talk to also get a perspective about how global trade is panning out for your sector. Thank you so much, sir, for speaking with us here this morning on NDTV Profit.
Thank you for having me.
Let's start by getting your take on the impact of the rupee. Is this really a kind of a tailwind right now? Does it make you more competitive?
Certainly it does. I mean, for an export-oriented manufacturer, weaker rupee always helps. It reduces our cost of manufacturing vis-a-vis dollar. So our cost inflation, which is all rupee denominated, has been on for the last, every year. And for the last 2 years, we've seen rupee fairly stagnant around 83 odd rupees to a dollar. So rupees, weakening now allows us to offset some of our cost increase. So obviously, it's margin accretive from that standpoint. So a weakening rupee does indeed help. Moreover, it also helps in being competitive in the market. So it is helpful.
To what extent, though? When you say margin accretive, to what extent can you give us an idea? And competitive to what extent? Vis-a-vis which nations? Because the Chinese currency also heading in the same direction. So does that advantage sort of pair off?
If you look at it from a global standpoint, obviously it's the relative depreciation which matters, right? So from a global competitor advantage, if rupee weakens more than any other competing country currency, then we have an advantage. But having said all of that, the global geopolitics is at the moment stacked against China. So there is obviously a lot of business flowing towards India for other reasons, not for rupee weakness reason. And then on top of it, if there is a weakness of rupee vis-a-vis the earlier position of rupee, I think it is helpful from a financial standpoint. I was only mentioning from that standpoint. But keep in mind that we hedge our receivables. So we hedge, into the future. So almost the next 2 quarters, we have already hedged, much earlier when we book the business. So this prevents us from, any currency volatility. So an immediate benefit from weakening rupee will not be felt in our P&L for a couple of quarters as we work on hedge P&L. But the direction is helpful from a longer term standpoint as a weakening rupee allows us to, build, since we bill our business in US dollars, a weakening rupee always helps us from a business standpoint.
Just one more point on okay, so we've talked about the rupee part of it, but there is a lot more going on in terms of impact on global trade. We could have a tariff war coming in. There is a textile hub, Bangladesh, going through tough times. How is all of this working out for the sector and for you, Mr. Ganapathy? If you can just give us a sense there.
Okay, so the global economy is all awaiting further announcements from the US, but at the moment it looks like Far East, which is China and maybe even Vietnam, may face some incremental tariffs. Time will tell how it pans out. So that automatically means that there is a business movement or relative competitive advantage for regions like India, Bangladesh, Indonesia and other places automatically. Having said all of this, with the ongoing challenges in Bangladesh as well, political challenges, there are a lot of brands or retailers who are looking at sourcing or moving a bit of sourcing from those regions to India as well. So this has resulted in us, seeing a fairly strong order book. And we've seen that traction go well into the forthcoming, into this year. So there is a good amount of tailwind, and I think it will stay that way for some time.
Okay, Mr. Ganapathy, about a minute's answer, please. Slightly running short on time, but would this therefore mean that the currency depreciation, and very likely that will stay this way, plus the Bangladesh benefits that come in, and a new season coming up on the anvil, would mean that calendar year 25 could actually be strong for a company like yours?
Yes, absolutely. Unequivocally, yes.
Unequivocally, yes. Well, that is music to the ears. I know you can't talk numbers because you must be in a silent period, but we look forward to talking some numbers with you, sir, after your quarterly numbers are out as well, because that will give us a chance to kind of talk about those things too. But thank you so much for joining in and giving us this perspective. Really appreciate your time.
Thank you. Thank you. Appreciate it.
It's to hear positive commentary from companies, and Gokal Das Exports saying it's an unequivocal yes that calendar year 25 will be better than calendar year 24. Okay, so that's great news. Not so great news for HCLTech, I'm afraid. Tamanna.
Yeah, and even Gokuldas exports, I mean, the stock not reflecting right now because I think that uncertainty on the rupee is one big factor. Look at HCLTech right now, about 9.5% down, and you know, our colleague Sajid Mangat has put out some of these reasons perhaps why. We'll get him in for a more detailed conversation before we hear from HCLTech, which we will in about 50 seconds or that countdown on your screen. But you spoke to the management leader, so I'm wondering what your view is. The point that total contract value all-time high, but TTM down 10%. Guidance is weak. I don't know if the guidance is weak because revenue guidance was actually put up.
Yeah, the lower end of the guidance is up. In fact, the commentary, the nature of the commentary also in the call yesterday and even in the conversation today seemed to be strong. But in fact, which is what we should try and do first. Before we talk to Sajid, maybe let's just try and hear out what the management had to say with regards to these numbers and the outlook ahead. A quick conversation with C. Vijay Kumar on what is to be anticipated in the year to come, more importantly in Q4 as well, which is going to be very, very important. Hear him out.
Q3 went largely in line with our expectations. The services business actually did a little better than our expectations. We grew 2.2% sequentially. The software business, obviously, this is a seasonally strong quarter. It grew very strongly, but on a year-on-year basis, there is a slight decline. That was a little below our expectations. Overall, top line, more or less in line with what we expected. In terms of margins, our performance has been good. We had launched Project Ascend, which is to bring a lot of efficiencies across multiple aspects of our overall operations. That is also showing good results. So we delivered a very good margin performance as well. And our TCV booking was, while the overall number is somewhat in the same range, but I think the little nuance there is the ACV growth is year on year 23%. That is, again, a very positive sign that smaller deals are getting converted and smaller tenure deals are increasing in the overall booking.
Is that going to be supportive of near-term growth? Almost everybody believes that will be the case. So therefore,
that's right.
You would second that as well. And is that the way to think of business right now as well, CVK? Because it might be difficult to really forecast 12, 18, 24 months out.
Yeah, I think, obviously, you need to make some assumptions and create a plan. But I think the confidence on what would happen in the near term, 2 quarters, is a much better estimate than a full year estimate, I would think.
Got it. You alluded to the software business YOY growth, which was a bit lower than you expected. Some people are talking about this due to a delay in signing certain large deals and renewals. So is this a case of justice delayed and not justice denied, in that maybe post this quarter things will improve?
Yeah, definitely. You have to see how those deals really, they're delayed. Now, will they positively convert or not is something which is still not certain. So we are still working on them.
Okay. A more macro question, CVK, and that's something that when we talk to analysts as well or market experts, they are also trying to understand that usually clients' budgets, if they would have been getting firmed up in the month of January, especially in the US geography, or maybe others too, is this time slightly different because the Trump swearing in is yet to happen, some of the policy clarity is yet to happen?
Yeah, I'm only kind of making a judgment based on what we saw in end of September versus end of December. We saw an improvement in the demand environment. Now, obviously, in the next few days, there can be significant changes in the overall business landscape. And the impact of that, I think it's very difficult to really factor in at this point because there are too many unknowns. So once we have clarity, that will probably be end of this quarter, we can provide you a good commentary on that.
Okay, so which is what I was trying to understand. So you do believe that there is an improvement and there could be even further improvement and further clarity that could come in at the end of this quarter round. Okay.
That's right. But of course, you have to keep in mind about the larger political and business landscape changes that could come in the next few weeks. And how does that change clients' priorities, their spending patterns? All of that is something we don't know at this point. We are just extrapolating what we saw in September and December end numbers.
Got it. And CVK, I would presume that it will be hazardous to make a guess or a hypothesis for a person in your position right now as Q3, right? I mean, you don't want to make that guess right now as to what it could look like.
Yeah.
Okay, fair call. On the margins as well, it's largely in line. Will it follow the same pattern? I mean, Q3 is a good uptake, Q4 seasonality, wage hike, something in a bit of a modest drop. Would that be the pattern, you reckon?
Yes. I think our margin pattern across quarters are very, very consistent. We start with a slightly lower number in AMJ. It improves in the September quarter. It further peaks in December and then moderates in March.
Got it. And that same pattern would continue. Okay. CVK, the big question is that will the nature of the deal wins? I mean, at least in the run up to the results and post the TCS results in the commentary that we had with, or rather the conversation that we have with people, most people are trying to understand, will the nature of the deal wins over the course of the next few quarters, if it's possible to hypothesize, be different than the traditional long tenor deals that IT service companies were used to winning as well. And there have been patches, right? Patches of very long tenor deals, then a bit of short burst of short tenor deals. How do you, is it possible to guess about what 2025 could throw up in terms of the nature of deal wins?
I think given all the changes in technology, generative AI and other aspects coming into play, I think the propensity for smaller size deals and shorter tenure deals are going to increase. That is what I'm seeing. So large deals could be broken up into smaller deals. Even a generative AI large modernization program could be done in different phases, and phase-wise we might be signing statement of works and things like that.
Okay. Last question or two, CVK. The big question mark overhang is ER&D and just trying to think about how you think about it, because you have a significant presence. One of the ER&D players' numbers haven't been the greatest. Auto isn't necessarily the strongest sector right now. How do you foresee spends by auto majors and thereby revenues for companies which are pure play ER&D or like yours, which have got this large presence?
Yeah, I think our ER&D business is probably the largest in the global system integrator space. It's close to $2.5 billion.
Right.
We've seen a good momentum in ER&D in the last quarter. It continued in the September, both in September quarter and December quarter, we saw a good uptick. Of course, auto segment continues to be a matter of concern. There are definitely significant ramp downs. The sector itself is under a lot of stress due to various things. So barring auto segment, I think it looks pretty good. And we are a well diversified engineering services provider. We have good presence in telecom, tech, manufacturing, and then auto, life sciences, healthcare. So I think given a diversified portfolio, we think the slowdown in auto can get offset significantly by some good momentum that we are seeing in other areas.
Interesting. Okay, so a good momentum, deal wins, improvement in discretionary spending, green shoots in BFSI, retail, all of these that the street has absorbed is now known. I have one final question, which is a bit of a technicality. A lot of people are now talking about, I mean, not now really, but through the years, the high payouts, the dividend yields remains amongst the best in the industry. You plan for that to continue, right? It's a laid out plan that you've given out maybe a few quarters ago that continues unabated.
Yes, our payout policy is we at least pay out 75% of our net income over the 5-year period, which started, I think, in 2021. So I think it's been a fairly stable, and our payout in the last 12 months is more than 90% of the net income.
So payouts remain okay, but clearly there is not a bit of a drag. There is a serious drag on HCLTech today post their numbers, 9% lower now. I stand corrected. When it was 6% lower, I thought it will not really end at those levels. It should recover because the commentary, to my mind, seemed okay. But
this is a pulping This is a beating, Neeraj. And then the question is that why to this extent? Why this extent of pain?
Okay, Sajid, any
Look,
thoughts?
there are a couple of thoughts here, and one is look at the order when it's in the average $2.1 billion range is coming in. But if you look at the trailing 12 months, it's nearly down 10%. So it's not showing order book growth which is coming in on a trailing basis. The second one is on the Q4 numbers. Of course, the lower end of the guidance has been raised to 4.5% to 5%.
Yeah.
Right. But that's been taken from a point of view that they've acquired an HPE business, and that's the reason why the lower end has been brought up. It's not the normal core business which is growing, that's why. Q4, if you look at, if the company is going to meet the 4.5% to 5% business, then we are looking at minus 1.6 to flattish growth in revenue, which is there. That's not the kind of guidance which is coming from other tech companies in that sense. And HCLTech has enough more than other companies like a TCS or other companies. So there is a correction which is in waiting for them. Because if you look at the entire tech rally, TCS has been the laggard in that. Infosys, HCL were the companies which were much ahead, and that correction is happening.
Relativity when it comes to other companies
and performance, and also because while you say that okay, the lower end of the guidance has been upped, so it looks better, but it's because of inorganic growth which is coming into play.
I actually want to pull up that one line because a bit of a contradiction there, and correct me if I'm wrong. You're saying lower guidance of the is up because of one client, but one major client is also disengaging.
Yes.
So, but you can't. You're looking at it both ways. Fine, one client has come in, that's why the lower guidance has come up, and also it's inorganic, right, because of acquisition.
Yes, so HPA business is expected to bring in 50 bips of additional revenue in Q4, but there's a big large client of HCLTech which is disengaging, which is in the consumer goods retail space, which is happening. And so, incrementally the core business which is there, or the organic business as we call it, that's not growing. It's an inorganic one which is coming in. So the impact of that core client is much more, it seems, in Q4, and that's what the street is pricing in. Had it increased the guidance or the upper band of it, then it would have been a different thing, but it hasn't. So the street is now calculating what kind of growth HCL is going to do in Q4, and which is coming from 1.5% negative contraction to almost flattish growth, which is coming in there. So it's basically adjusting to that entire thing. So commentary is good. I saw what Vijay Kumar had to say. The commentary is good. He's talking about smaller deals coming in, but smaller deals coming in also brings in challenge of TCV going forward, because you need to have so many deals to get that average order book.
But I think their call, Sajid, seems to be, and I wonder if TCS has said the same thing, that a lot of deals are right now shorter tenor in nature, because they are Gen AI related deals as well, which are naturally shorter tenor in nature, but they actually support the near-term growth, which is because gazing out 12 months out is virtually impossible in the current status for any company right now.
And then the reverse. If there is dependence on just few larger deals, that's also a negative. I don't know. I feel that this is, sometimes we end up doing a bit of a post-facto analysis. Everything you're saying, Sajid, absolutely valid. Does it warrant the kind of hit, 9%, 9.5%, nearly 10% down?
We should look at what the stock has done in the last 6 months.
Let's look at that chart.
And then we can compare it with Infosys or TCS, and then see the relative performance of those companies. And the kind, of course, the expectations are high from Infosys, which is coming, I think, on Friday, if I'm not wrong. But
16% up in the last 6 months.
And compared to Infosys or a TCS.
Yeah, Infy is about 13.5.
Yeah. So not.
TCS would have lagged for sure.
Yes.
TCS is just 2%.
Yes. So so that catch up is happening right now. Putting everyone together is something which is there. So one clear theme which is coming out from two big IT companies in this quarter is that smaller deals are coming in, discretionary is coming up. BFSI US is working, Europe is still laggard, and if you look at the deal pipeline, it is taking much more effort to create that deal pipeline.
What about the currency point?
Currency is a very interesting fact. When I was speaking to TCS, they said, rupee depreciated, and so we should have enjoyed that depreciation.
Yeah.
But more than half of our revenues are coming from pound or euro based, and against that rupee has been relatively stronger.
But they also have a very large Indian client as far as TCS is concerned.
No, that's tapered out.
Okay.
So in Q3 it tapered out, and Q4 it will completely go off unless they get the 5G order from BSNL. Otherwise it's not. So they are talking about the growth despite a BSNL tapering off. Here, you know, there is a tapering off of one of the big clients which is happening, but they're not able to compensate it against the growth.
Could be several reasons. Thank you for that, Sajid. But you know, we're going to analyze this further because big drop in HCLTech. We need to understand what's happening with it. Omkar Tangsale joins us on the other side of this very short break to tell us what to do with your tech play. He tracks the sector very, very closely. Stay tuned.
I present the budget for a historic.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with.
Markets losing steam, except I would say for banking stocks to some extent. Nifty off its day's highs, and that pressure and the Nifty largely coming from the IT pack. I mean, there's no question. Like you had TCS, the only story a few days ago, you have the only story today is HCLTech. Pull up the components of the Nifty IT for a second. Yeah, there you go. All in the red, but nothing beaten as badly as an HCLTech. LTI Mindtree also looking a little shaky. Tech Mahindra, L&T Tech. Infosys ahead of its numbers is fine. I just want to pull up TCS independently and see what it's doing, because it is the last big comparative we have, right, for what we have seen perhaps with HCLTech holding up. TCS is holding up fine. But the story again is the bank Nifty. Bank stocks doing well, and over here also the PSU stocks raring to go in relative terms. But yeah, this morning I would say, Neeraj, all about HCLTech and some picks over there that are moving.
Yeah. I mean, that is one, of course, to note. In moments from now, we'll also get in somebody from HCLTech, but the primary markets, right, and Quadrant Future Tek, we'll just take a minute here because the listing is due in about 30 seconds or thereabouts, or maybe 45 seconds, but a heavily subscribed IPO, amongst the most well-subscribed IPO in recent times, if I'm not wrong. And looks like it will probably start off on a good footing. Just the perfect day. Had it been yesterday, who knows, the things might have been different. But it does look like that the listing will be healthy. The question only is, can it build on from there? Can Quadrant Future Tek? This is the Kavach maker, and those orders have come in thick and fast. The execution timelines are about 12 months, so there's serious visibility in a lot of these orders. And for a stock that was subscribed 264 times by retail and HNI is by about 275 times. Suffice to say, the listing should be strong. Let's just show what the price is before we move on to the other conversation points on the show today. But Quadrant Future Tek lists at a premium of 31%. It's not bad, by the way. Remember, the 50% listings are off. Even the recent listing, which got heavily subscribed, listed at only about 21 times. So, but this 32% gain on listing is not bad at all. This is something that people should be happy with. So keep that in mind. What people should.
We're looking for reasons to be happy.
Yeah, but what people may not be happy with is HCLTech's moves. And let's put that into perspective with Omkar Tanksale, senior analyst at Pasuki India. Omkar, good having you. Thanks for joining in. What explains this sharp gash today? Are you as disappointed with HCLTech numbers and the guidance?
Yeah, thank you and good morning to all. First, coming on to the HCLTech results. HCLTech results was largely, in line, but on a revenue front, they were declined and stood below than our expectation. In its product and platform business, which is considered to be a strongest quarter in Q3, has actually a decline on year-on-year basis. I mean, its paying subscription and support-based software products have declined on Y-on-Y in 5.8%, and its perpetual license upfront and others business has declined 15% Q-on-Q. Apart from that, there are three major reasons that the HCLTech has been dragged down because of the large completion in the retail and CPG vertical of the project, the planned reduction in mega deal driven work in the telecom side, and the delay in ramp up of the discretionary deals. Apart from that, the commentary from the management still looks to be positive, but I believe the muted deal TCV as compared to the Q-on-Q, and these three reasons have dragged the stock, and largely on a punchy valuations that is there on the HCL side. So that have dragged the HCLTech, but commentary looks to be constructive and as an overall IT sector and likely to have the positive impact going ahead.
So, yeah, which is what my question was though. So let's assume there's somebody, a shareholder of HCLTech, looking at this 9% gash and thinking that is this a chance to get in? Because when I interviewed the management as well, their calls seem to be that things are not looking bad. Discretionary demand is picking up, select sectors are okay, and their ER&D vertical, even if it gets impacted by auto, they will see a recovery from some of the other pieces as well. So what's your sense? This 9% gash, does it give a chance to buy, or would you bide your time?
No, I believe the valuation is quite high. I mean,
Even
that's
now.
why the stock has been corrected. So one should wait and, should not enter. There are a lot of other opportunities as well, which has been corrected. Even Infi and TCS were trading at similar levels. After the results, India TCS have grown, but there are multiple factors. But I believe one should wait if rather than buying at the current on the current correction, and one should look at what exactly happening in the company for next couple of quarters.
So don't buy right now is the point you are making. Okay, Omkar, just one follow up here, because I think the numbers that have come in from an ER&D company thus far, HCLTech saying that ER&D other things are okay but auto is not. What happens to auto focused ER&D stocks? I don't know if you track that, but presuming that you do, what happens to a Tata Tech? What happens to a KPIT? Would you be negative there?
I mean, it's a volatile condition from the European side. The spend from the ER&D has been reduced, and there is a lot of demand side constraint is looking. So that's why they have the expenditure is likely to come. So everybody is expecting the ER&D expenditure is likely to curtail down for the next financial year. However, these conditions are not, persistent, because the dependency of these automobile companies have grown significantly on these ER&D companies. So the spending will likely to come. However, this is the period of the sluggishness in the demand side. So the spending curtails is likely to come for the next 2 to 3 quarters at least. That's why these ER&D, European dependent ER&Ds is facing the struggle.
Omkar, hi, Tamanna here. Just if I were to ask you in very simple, straight terms, does HCLTech deserve the kind of battering it's getting? Our numbers that bad, and what is the top reason for the fall? Is it in relative terms a valuation that is being seen, or something seriously concerning?
No, I believe it's more of a valuation concern, and also there is a ramp down of the deals, the large deal wins from the CPG, retail, and from the telecom side. And apart from that, the valuation concern is still there. So there are 2 to 3, the mixture of 3 both. If you have seen the results overall, it's ER&D and the product and platform business who perform better as compared to the IT services. Actually, the IT services have grew only 1.5% Q-on-Q in CC terms. So that might have impacted on the stock price. But I believe the company's performance is consistent with what the management has already said. So it's in a longer run, it will hold the price as the company grows. But currently, yes, the valuation looks to be expensive.
It's a valuation play largely. That's why 9% down. Just how does this set us up for Infosys coming in? What would you look at very, very closely as we await Infosys numbers?
See, Infosys is having the large discretionary spend contained on its order book, but I believe it's an execution master. One should see how the things are getting ramped up, how their engagement is getting. So commentary from the management itself is likely to, it's been very important, and on the revival in the large deal wins and the turnover on those deals will crucial things to watch out for.
Okay, thank you for that, Omkar Tangsile. Watch out for Infosys next. HCLTech, perhaps a victim of valuations today more than anything else. And the size of deals now, when things go bad, everything becomes an issue. And I suppose all of those reasons now coming to the fore. But let's take stock of Adani Green. In focus, the company's transmission order book has skyrocketed in the third quarter. To tell us more, we're joined now by Mihika. Yes, Mihika.
So Adani Green did, post its provisional update for Q3 FY25. Something that did stand out was the transmission order book. The company did win a total of 28,454 crores. It won the Khandwa Phase 4 Part D at a project cost of 3,455 crores, and it won the Rajasthan Phase 3 Part 1 order for a preliminary project cost of 25,000 crores, and this marks its largest order win till date. Now, under construction project pipeline for Adani Green now stands at at 54,700 in their transmission business versus 17,000 crore at the start of FY25. In terms of other key operating metrics, while the transmission network length was up 30% year on year to over 26,480 circuit kilometers, and their power transmission capacity was also up 54% on an annual basis to 84,286 MVA, and this is on better execution as well as additions, to their portfolio.
Okay, well, its stock is up 7.5%. So clearly, in focus is this one. The other one, just wondering. I mean, Mihika, MGL, right? And I think Morgan Stanley has this note with an initiating coverage, and this is the Asia Pacific note that has looked at MGL, which is why the stock is excited.
So very bullish view. It's initial coverage with an overweight rating. Target price is at 1,606, which implied a 25% upside potential to the previous close. They are betting the growth on Mumbai's travel needs, all the road and infrastructure works paying off, and it's key for MGL's value creation as per the brokerage. Now they expect the Mumbai vehicle population to rise 13% by FY30, and there's over a 125 billion annual miles market, which is an untapped market opportunity for MGL, and they expect the company's market position to also more than double. And they also had a note come out a few weeks ago about the future of Mumbai's energy, which is natural gas, and they are saying that every oil to CNG vehicle conversion provides 20 years of assured cash flows for Mahanagar, and they like in that perspective they like MGL's strategy to give cash incentives for heavy CNG conversions. They have noted that margins will be lower because of the company's gas sourcing from the spot LNG markets where prices are higher, but volume growth will be structurally higher. The only key risk that maintained is slower CNG demand on new public transport as well as higher costs.
Thanks for that, Mihika. Now, just before we get in, Vetri Subramaniam, a quick word from Harsh on the note on PFC and REC. It assumes significance in light of the fact that IREDA has had a slightly iffy quarter. Harsh, what does Macquarie have to say?
Well, Neeraj, good morning. Macquarie is suggesting that while IREDA's GNPAs were impacted by a one-off account, they don't see that hampering or impacting the progress made by REC and PFC in terms of asset quality. So they are expecting REC PFC's asset quality to remain robust, recoveries to continue, healthy ROEs to sustain, and they're expecting a 13 to 15% growth from both PFC as well as REC on a sustainable basis. They're seeing huge value in both of these, 700 being the target price on REC. They've hiked the target price there. PFC 2, target price being 660. Again, a 50 to 65% upside on both of these is what Macquarie sees. No asset quality concerns there. They're also saying that likely the fall last week for both REC and PFC was because of IREDA's numbers, and that is unwarranted. That's the point they're making.
Okay. Thanks a lot for that, Harsh. So unwarranted, and which is why it's showing the kind of moves today, both PFC, REC. The question is the fall at the broader end of the spectrum unwarranted, or is it part of what a cycle of the market goes through every time it becomes very expensive? Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Johnson on the show. Vetri, good having you. Thanks so much for joining in. And at the onset, wishing you a very happy 2025. That's a new look, Vetri. You keep on changing it every year, is it?
Well, something's got to change, right?
Something's got to change. Will the market change, Vetri, is the question. I remember 2022, was it, wherein you gave that really nice acronym or a sentence to us that it is from Tina to Tara. Yeah, what is it this time?
I don't have an acronym really for this year. I'd say more of what we were saying last year, which is to focus more on asset allocation and risk management. And, in the mutual fund space, what we've therefore been saying as a derivative of this, asset allocation and risk management is to look at the hybrid schemes. Simple logic being that given where valuations are, it makes sense to not go full in on equity. And secondly, the carry on fixed income is looking reasonable enough. So use asset allocation strategies to navigate what is likely to be a difficult period. Now, not that a year ago we knew that growth was going to slow, but we certainly had a heads up from valuation, which was giving us enough reason to say that, you need to traverse this area a lot more cautiously.
Vetri, hi, good morning. Tamanna here. And, great to speak to you, especially at a time of so much uncertainty. What is going to be that one key factor moving markets ahead? Are valuations going to come to the fore? Is it going to be the quality of corporate results that we're seeing? Or is global factors that are pretty much out of our hand?
I'm going to invert that and say, if you're coming to the stock market and investing on the basis that you will have certainty at all points of time, and your vision will be 2020 in terms of everything that's going to happen ahead of you, then I think you need to rethink your framework. I think investing is all about probabilities. It's all about dealing with the future, which is always consisting of some uncertainties, risk of unknown, both the known unknowns as well as the unknown unknowns. So this is part and parcel of the journey. Second point that I would make is, if you're talking about certainty in terms of the fact that equity prices should always go up, I think history is giving us a very good reason to realize that drawdowns are part and parcel of every equity market journey. I think investors actually do understand that. And, I take great satisfaction in the fact that we are seeing such a large amount of flow come through the industry by way of systematic investment plans, because it means that people have realized that volatility is intrinsic to the equity market journey. And the way you tackle that is not by trying to predict whether the market will be volatile or it'll have certainty, but by making sure that you are spreading out your investments over time and allowing the volatility to play to your strategy rather than trying to fight it.
Okay. Vetri, so interesting. I mean, what would the launch of a quant scheme do in a scenario like this? I mean, is the quant looking at trying to maximize the view that you've just expressed, which is not be all out in equities, or typically a quant wouldn't be a hybrid fund, right? So what explains that?
Yeah, I think that's a great question. You're absolutely right. This is not a hybrid strategy. In fact, we were already running a hybrid strategy which had a underlay of quant in terms of the way we manage the portfolio, but this is a pure equity portfolio. From our point of view, we think of this really as more of a all-weather strategy. The reason we think it's an all-weather strategy is that it is built on what we call integrated investing. It integrates our bottom-up abilities as a research house in terms of the strength of the research team and the experience that we have. But in terms of the construction of the portfolio, it is rule driven. It is based on certain quantitative parameters that we use, and primarily we use a factor approach towards investing. So the four key factors that we look at are quality, value, momentum, and low volatility. And the model is adaptive. So unlike many of our other active strategies, in this fund, what we are trying to do is, based on past history, try to look at what is the kind of factors which are likely to extract better alpha relative to the market in the current environment, and then try to position the portfolio in those factors. But the stocks that we would use to replicate those factors are stocks which come out of our bottom-up research process. So that's why we call it an integrated investing approach. It is very adaptive in its thought process because it's constantly adapting to what the market signals are telling us, and therefore it's also fundamentally very different from the way we run our traditional equity strategies, where actually I would say we don't look at market signals. We do look at valuations and fundamentals, but not really market signals. But in this strategy, we look at market signals, and therefore I think it has the benefit of being all weather.
Just a follow up there, so there are styles, right, that the market rewards consistently. I mean, aside of the the traditional styles, momentum investing suddenly found favor, etc. Would you believe that factor-based investing could be the style that will get rewarded in 2025, or not necessarily so?
So actually, this is very interesting, and this is one of the points we tried to make when we were talking to investors about this strategy. When you think about factors, Neeraj, and I'll just take four simple ones, momentum, low volatility, right, quality, and value. Yeah. When you look at their performance over very long periods, I'm talking about 10 years, 15 years, 20 years, what you find is that each of these factors has ended up creating an alpha relative to the benchmark. right? So really what you should learn from looking at factors is that discipline is a very significant component of the outcomes that you experience as an investor. But what this means is you need to pick a particular factor and then stay with it through all its periods of ups and downs when it might outperform or underperform the benchmark. Now, what we are doing in this strategy is recognizing the fact that even within that 20-year journey, there are shorter term cycles. So there could be a 1-year period where momentum does brilliantly well, but there could be a shorter period where it does terribly. Same for quality, same for value. These two factors in particular tend to sort of alternate in terms of their performance cycles, typically over 2 to 3 year periods. So in this strategy, what we are trying to do is use a decision-making framework which tells us whether to go in favor of quality or value, and whether to tilt in favor of momentum or in favor of low volatility. So that's the way we do it over here. And what we are trying to do, therefore, is give the investor a good experience in terms of alpha generation on a more consistent basis over a long period of time and improve the risk-adjusted returns. But the bigger point that I would point to, which was your question, disciplined investing in factors tends to pay just as disciplined investing is always likely to pay in your favor, rather than trying to switch your horses every few months or every few days.
Yeah, no, that point definitely taken, Vetri. It's like if you want to consistently be healthy, then crash diets aren't going to help. You have to be slow and steady, I would say. Having said that, what is too rich for your blood right now? In the sense that when you're looking at valuations in the system, you're looking at some of the results coming in, the drawdowns that have already taken place. Is there anything looking ripe for the picking to you?
Sure. So, I've said this before, when I look at it at a sector level, I think banking financial services is where we have the maximum comfort. Sure, there are challenges. There have been interventions. Credit growth has, slowed a little more than I would have expected a year ago. But the fact is that valuations give you a lot more comfort in this area. So we would be comfortable taking that risk over here. On the other hand, if I look at an area like industrials, we are a lot more cautious because over there, the valuations are very, very rich. And I do think it's starting to kind of boggle, at least my thought process, in the sense that in an economy where nominal growth is currently running below 10%, and remember, this is looking to look more and more like the norm, it's very hard to expect that corporate profit growth can continuously deliver in the high teens or even about 20%, which is the number which has to be embedded in terms of expectations if you're looking to buy industrials at PE multiples, which start at about 40 to 50 and then go way above that number all the way to, triple digit valuations. So industrials is one area where I'm hugely challenged in terms of valuations. BFS is where we have a lot more comfort.
You have comfort in BFS. Do you think that this is the year when private banks make a bit of a comeback?
Certainly, I hope so. That was our view a few months ago. It's been a little belied. It's not played out immediately. But at the same time, I think these, private banks in particular, Tamanna, very well placed in terms of their capital adequacy, very well placed in terms of their ability to absorb any credit costs. And, their incremental market share in terms of deposits and loans is so high that, to my mind, this is possibly one of the few alpha opportunities, I would say actually absolute return opportunities in the marketplace today when I think about it over a 3-year basis.
And how are you looking at IT? I mean, of course, today is one big sort of very bad day, I would say, red day for an HCLTech. But the IT question still sort of hangs in the balance. You have a new government coming into the US, a very strong economy, but interest rates don't look like they will go down anytime soon. Yields are going up, dollar is strong. With all of those factors, is the view on IT turning more positive, or you're on the fence right now?
Look, I think when it comes to IT, what we need to remember is that these are India's most globally competitive companies. They have created value over many years and decades, and I think they'll continue to do that. But fact of the matter is this is a sector which has seen a massive re-rating, not just in terms of prices, but in terms of valuations over the last, I would say, 6 to 8 months. So I'm not surprised that it's running into a little bit of headwinds over here. It's also got the benefit of the election trade, the view being that, with the new administration, tax cuts and all of that, you'll most probably see a wave of spending come through in IT. So I think the stocks ran a little bit ahead of that. Valuations don't really give you too much to play with over here right now, but structurally it's something that I would stay positive on. Valuations, maybe you need to sort of bide your time for a little bit over here because they've had such a strong run.
Vetri, one final question from my end. There was this chart that I was seeing posted by ValueQuest, wherein they pointed out that how during crisis situations it's different, but otherwise the share of large caps in the overall profit pool has largely been going down. Right? It could well be because companies are getting added at the small cap and naturally so, and therefore by sheer numbers they will not be able to replicate. But if indeed small cap profit performance and the pools of profit at the broader end of the spectrum are large because a lot of sectors are now getting unearthed and getting listed, should one not be too wary of small caps? Yes, there has been a lot of value destruction in the recent times, but is this an opportunity therefore?
I'm not in that camp, Neeraj. I actually think the small caps are still very richly valued. They're at a premium to the large caps. And look, when you look at the earnings estimates, right? I mean, you've got nominal GDP growing at 10%. The forecast for large caps is 12-13% earnings growth in March 2026. And then I look at the mid caps and small caps, and people have earnings growth for the entire universe of 150 and 250 small caps running at 18 to 20%. Now, this is starting to boggle my imagination a little bit, that in this kind of a low growth economy, how are you going to develop this kind of strong growth? It either means nominal growth has to blow out in terms of sales for these companies, or profit margins have to expand. And I think that's not a risk that I'm willing to take. There could be a few companies that do it, and I'm pretty certain some companies will do it, but that's very different from 150 mid-cap companies and 250 small-cap companies in aggregate delivering those kind of outcomes. And that's why I tend to be a little bit, wary of what I'm seeing in the mid and small cap space.
Okay. Well, Vetri Subramaniam, always a pleasure talking to you and getting your insights. Thanks for taking the time out and being with us today.
Thanks, Neeraj. Great talking to you as well.
Yeah, thank you. Well, that's the view. And, well, Vetri certainly believing that you need to be waking up and smelling the coffee, if you will. If you're betting on mid caps and small caps as a blanket, specific pockets within that, sure, those could do well. But on that note, and on a very good note, by the way, I mean, we can just pull up the Nifty ones before we wrap up the show today. Because yes, there are red points, and yes, the markets have come off, but we are in the green. And that's a respite. Let's see if this lasts or no. From Tamanna and me and the team that put this show together, thanks so much for tuning in. Up next is Ask Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. This show gets you answers to all of your stock-related questions. And you might have quite a few of them today, particularly after yesterday's difficult session. You can call it that. There's a bit of a bounce in trade today, of course. And you have the benchmarks that